The second session is going to be as exciting as the first session was, because it is going to be issues related to input tax credit, I think, which is a pinpoint area, the most disturbing area for any corporate or any practicing chartered accountant or professional, which will be taken by none other than CA Tushar Aggarwal ji. I'll quickly introduce Tushar sir. Tushar ji is a founder partner at Tatvam Advisors and heads the litigation practice there. Tatvam Advisors is an emerging indirect firm of India having team size of more than 40 members, handling more than 100 big corporates and MNC clients. Tushar sir has more than 10 years of experience in indirect tax litigation and advisory. He has worked for more than 8 years with Lakshmi Kumaran and Sridharan attorneys. He was also deployed by GSTN for GST implementation and has worked closely with government officials. He has worked extensively with the Government of India designing the GST returns, audit and other formats. Along with that, Tushar sir has deliberated in more than hundreds of webinars since the lockdown, and I think he has deliberated in the physical webinars as well. So with this and without making much of time, I would like to hand it over to CA Tushar Aggarwal ji for the issues related to input tax credit. Over to you, sir.
Thank you, Shubham. I'm just sharing my screen.
So we have a question. What are the timings of the session? So the timing of the session was from 4 to 6, but I think we are going to exceed by 15 to 20 minutes. So request you to kindly take out time to your prior commitments, because all the next 3 speakers are going to be very interesting and the topics are also going to be very engaging. Over to you, Tushar sir.
Thank you, Shubham. At the outset, I would like to thank Webtel for giving me this opportunity. Good evening to all the participants and the co-speakers, Rajendra ji, Rajat ji, and other co-speakers. So in next 30 minutes, we will be covering some of the major issues related to input tax credit. So the first issue which we will discuss is relating to handling of notices in respect of differences between GSTR 2A and GSTR 3B. We all are witnessing that we are getting such kinds of notices from the department. So we will deal in detail how to reply to those notices. Second, ITC on CSR activities. In last couple of months, we have seen that the organizations and the taxpayers have contributed a lot in respect of CSR activities. So whether the ITC is available or not, and what should be my strategy. Thereafter, we will see one of the conditions under the ITC law, which states that payment should be made within 180 days of the date of invoice. Otherwise, ITC has to be reversed. So we will critically examine that particular condition and try to find some solution to those conditions. And in the end, we'll be discussing one of a very interesting issue in respect of a real estate industry, which almost every real estate industry is facing, and a big amount of DGGI investigation is happening. That is ITC reversal on completion of project. So these are the 4 issues. Moving on to the first issue, how to handle notices for difference between GSTR 2A and GSTR 3B. Friends, we all are witnessing that we are getting such kinds of notices from the department. Such notices can be in the nature of an assessment scrutiny of written notice under section 61. So under 61, they are issuing notices for difference between 2A and 3B. Even during departmental audit, we may find that one of the issue which they are raising is a difference between GSTR 2A and 3B. So how to deal with this during the departmental audit. Third, we are witnessing that they have actually issued show cause notice under section 73 and 74, specifically demanding ITC reversal along with interest and penalties. So whenever we receive all these kinds of notices, how do we approach and how do we make reply and how do we fight? And really, are we required to reverse the credit or not for all the past period? So for this, we will divide our entire discussion into 3 periods. First is from 1st July 2017 till 8th October 2019. Why 8th October? Because on 9th October 2019, Rule 36.4 was inserted, and Rule 36.4 specifically said that the maximum credit which is available to the taxpayer is what is auto-populating into a plus 20%, which is now 5%. So this will be my first period. Second period will be when Rule 36.4 got implemented, that is 9 October 2019 till Budget 2021 amendment becomes effective. Budget 2021 amendment has is a big impact. There is an amendment, we will discuss about this in the amendment, which is not yet effective. So these are broadly the 2 periods which we will be covering. Moving on to the first period, that is between 1/7/2017 till 8th October 2019. So whenever we receive a notice related to 2A 3B mismatch, it may be a scrutiny of return notice, show cause notice, during audit, etc. Whenever we receive such documentation, the first and the most important exercise which you have to do is that you have to check the numbers. What we have witnessed is that whenever a notice is received and they say your 2A figure is this, your 3B figure is this, and there is a mismatch of 1 crore rupees. Actually, mismatch is not of 1 crore rupees. Their 2A figure is not correct. So many a times at various states level, we have seen that this figure is incorrect. So the first exercise which you have to see is that whenever you get a notice, please do an updated reconciliation. So whenever you get a notice, please do an updated reconciliation with the latest 2A versus 3B. So whenever you do an updated reconciliation, then you will come to know the exact mismatch figure. So when you do an updated reconciliation, say in our example, the notice was for 1 crore rupees mismatch. You do an updated reconciliation, you come to know that my 20 lakh is getting matched. It's only 80 lakh which is mismatched. The first point which you have to write is that the data is not correct. Actually, the mismatch which is coming is only 80 lakh rupees. And within this 80 lakh, there will be 2 kinds of vendors. First set of vendors will be those vendors who are saying that we have filed the return 3B and we have paid the tax. It was a clerical mistake by virtue of which we could not upload in GST 1 and hence it is not coming in your 2A. So first category of vendors are those vendors who are supporting you, who are telling you that we have paid the tax in 3B. But it's just that I have wrongly filed my GST 1. There can be various reasons. For example, he may have reported the B2B supplies as B2C supplies. He may have reported a wrong GST number. He may have missed reporting the invoices. So today for 17, 18, 18, 19, you cannot report and you cannot rectify GST 1. So in fact, in these cases, he has paid the tax, but the invoice is not getting auto-populated in GST 2A. So in such cases, you don't have to reverse the credit. You specifically write in the reply that these are the vendors who have, these are my first category of vendors out of 80 lakh rupees who have actually paid the tax to the government. It's only a clerical mistake by virtue of which it is not coming in my 2A. Get a declaration from them. Get a declaration stating that they have issued these invoices to you. They have paid the tax on these invoices in GST 3B of this month. However, inadvertently, they have missed out to report in GST 1 and hence it is not getting auto-populated to the recipient GST 2A. In any case, the tax stand paid. So in these cases, in my view, there is no need for reversal of credit. It's a settled law. It's a procedural lapse and the substantial benefit cannot be denied. He has paid the tax. So it's just a matter of auto-population. The mere fact that it is a statutory, like in Bangalore Chemicals, it's a very important observation. I will just read for the benefit of all. The mere fact that it is a statutory does not matter one way or the other. There are conditions and conditions. Some may be substantive, mandatory, and based on consideration of policy, and some others may be merely belong to the area of procedure. It will be erroneous to attach equal importance to the non-observance of all conditions, irrespective of purpose they are intended to serve. So in these cases, there is no requirement or reversal of credit. And in fact, recently the Kerala High Court in GST regime itself has said, the Kerala High Court in Joseph T has said that if supplier is providing the proof that he has paid the tax and DRC 03 is filed, no reversal can be sought from the recipient. Use that judgment in our reply. Moving on to the second set of vendors. Those vendors who have not filed GST 1, who are not giving declaration to you, who have not paid the tax in 3B, they are not supporting to you. but you have fulfilled all the conditions. As a taxpayer, as a recipient, you have received the invoice, you have got the goods, you have paid payment to him. It's just that the invoice is not getting auto-populated in 2A and you are not getting support from the supplier. There is no proof whether he has paid the tax or not. Whether am I required to reverse the credit in such situation for such kinds of vendors? My answer is no. Even for such kind of vendors, we are not required to reverse the credit. And there are 5 major grounds for this. Ground number 1, when we see section 16(2)(c), it starts with subject to the provision of section 41 and 43A, the tax charged in respect of such supply has been actually paid to the government. So this condition which talks about that the supplier should have paid the tax, this particular section starts with subject to the provision of section 41 and 43A. When we see section 41 talks about provisional availment of credit, and then we have section 42 and correspondingly rule 69 and 71. The entire section 42 read with rule 69 and 71 is a complete code for matching, reversal and reclaim of ITC. And the entire law, the way it is drafted today, the entire sections, the entire rules, they all are based on the old concept of GSTR 1, GSTR 2, GSTR 3. So, and we see these provisions and these rules. The entire matching principle is based on GSTR 1, GSTR 2, GSTR 3, along with mismatch report in MIS 1 and MIS 2 format. Friends, when we go to the portal today, do we see any form called GSTR 2? Do we see any form called GSTR 3B? Do we see any form called GST MIS 1 or MIS 2? The entire forms have been kept in abeyance due to technical glitches. And what is prevailing today is only GSTR 1 and 3B read with 2A. So the first argument is that this section 16(2)(c) is based on section 41, and when 41, 42, these all sections and rules are based on GSTR 1, 2, 3, and you have not yet implemented GSTR 2. You have not yet implemented GSTR 3. You have not implemented MIS 1, MIS 2. Therefore, this section itself is not implementable. Section 41 is not implementable. And if section 41 is not implementable, it is deemed that section 16(2)(c) cannot be implemented. A very, very good ground to fight that no reversal is required. Moving on to the second ground, it's a settled principle. The law cannot compel the doing of impossibility. They cannot tell you to do something which is impossible. Friends, it was only in October 2018 for the first time GSTR 2A was introduced. In 17-18, you never ever had any GSTR 2A which give detail to you regarding whether the supplier has filed the return or not. So it is for the first time that GSTR 2A was introduced, then how can the government expect you to do the matching? Apart from that, even after introduction of GSTR 2A, you cannot check whether the supplier has paid the tax or not. So what is GSTR 2A? 2A merely reflect the fact that he has uploaded the invoice in GSTR 1. It may so happen that a supplier is supplying invoices and putting it in GSTR 1, he has filed GSTR with a turnover of say 100 crore rupees. He has uploaded all the invoices. It is being reflected in your 2A. But when he goes and files GSTR 3B, he files GSTR 3B with an amount of only say 5 lakh rupees. So in GSTR 1, he has shown 100 crore rupees of liability. But when he go and file GSTR 3B, he just writes 5 lakh rupees as tax liability. And yes, it is possible. 3B, you can manually add it. So what you will see as a recipient, you will see that he has filed GSTR 1, hence the invoice is coming in your 2A. What is the status of GSTR 3B? Filed. But whether the government has got the revenue, the answer is no. So there is no IT system in place in today's scenario wherein you can check whether he has paid the tax to the government with regard to the invoice which he has issued to you. Friends, if you recall, when GSTR 1, 2, 3 was implemented, during the implementation process, when it was supposed to be implemented, the law was that whatever he puts in GSTR 1, the same will get auto-populated in GSTR 3. And in GSTR 3, he has to make the exact payment and he cannot amend GSTR 3. Now, since GSTR 3 is an abeyance and GSTR 3B is a manual exercise, there is no mechanism to check or not. Third major ground, The law has not made distinction between a bona fide buyer or a fraudulent buyer. In VAT regime, we have various High Court judgments. Delhi High Court in case of Arai India, then we have Karnataka High Court, Punjab and Haryana High Court. What all these courts have said? They have said no liability could be fastened on a buyer on account of non-payment of tax by the supplier in the treasury unless a case of fraud is made out by the revenue or unless collusion between the seller and buyer is established. So this is this. You can always argue that I am a bona fide buyer. I am a bona fide buyer. I have fulfilled all the conditions and hence the right should be available to me as there is no proof of any collusion. We should make use of all these judgments in our reply. Moving on to the fourth ground, the press release issued by the government. The press release which was issued in September 2018, October 2018 itself said, the press release itself said, the apprehension that ITC can be availed only on the basis of reconciliation between GST 2A and 3B is unfounded. So that's a very important ground. Moving to our last ground, a very important judgment of the last High Court. What happened in this particular case? The authorities were investigating the seller and they came to know that seller has not paid tax to the government. What these authorities did, they issued show cause notices to the recipient, asking them to reverse the credit. And when the writ petition was filed before the Honorable High Court, what the High Court held? They said that, please go and examine the supplier first, collect tax from him first. You should go and investigate him. It is the supplier who has not paid the tax. Why are you coming directly on the recipient? So the fifth ground which we should write in a reply that using this judgment that we have fulfilled all the conditions. If supplier has not paid, please investigate the supplier. You have all the data, go and investigate and don't demand reversal from me. In my view, basis all these five grounds, there is a good case to argue that no reversal is required. Moving on to the period post 9 October 2019, when Rule 36(4) was inserted, which specifically said that under Rule 36(4), the maximum credit which is available is what is auto-populated in portal plus 20%, which is now 5%. In my view, even after insertion of this rule, the position remains same. Whatever arguments we have taken, the same will sustain. Apart from that, an important argument which you have to take is that Rule 36(4) is ultra-virus vis-a-vis the section. It is a settled principle that existence of an enabling section in the statute for the purpose of making rule is necessary, which is absent in the case of Rule 36(4). And to collaborate this fact, I will draw your attention to the recent budget amendment in section 16, which specifically inserted a new condition. And what is this new condition? It said the details of the invoices or debit note referred to in clause A has been furnished by the supplier in the statement of output supplies, and such details have been communicated to the recipient. If we see this section 16, it is for the first time they are writing in section 16 that the invoice should be uploaded by the supplier, which will be communicated to the recipient. Until now, there was no such condition under section 16. And in fact, this amendment is also not yet effective. When all the states legislature will pass the budget and then a notification will be issued, then this amendment will become effective. So basis all our discussion, the law which stands today, even if there is a mismatch between 2A, 3B and there is no collusion, there is no fraud, and it is a genuine transaction, for all the notice purpose, for all the litigation matter, you can very well argue no reversal required. And what practically is happening, sometimes we face pressure. Sometimes we face pressure from departmental audit, from anti-evasions, etc. And we are required to reverse the credit. We are not able to deal with those pressure, etc. So my advice to you is that even if we have to reverse the credit at ground level, even we have to reverse the credit at ground level, please write a letter to them stating all these grounds that in your view, reversal is not required, but you are reversing under protest with the right to reclaim. So whenever in future you get a favorable judgment, there is a favorable judgment on this topic, you will be in a position to reclaim the credit. Friends, please note, there is no timeline to reclaim the credit. You can reclaim the credit even after September month time restriction. And this is for the reason that this time limit, which is under the GST law, is applicable only for the credit which you avail for the first time and not for the second time, that is reclaim. In excise, there are various jurisprudence. Aurobindo Pharma judgment of tribunal. Then we have a 2014 circular which stated that the time limit will never be applicable in case of reclaim of credit, because in excise also we used to have that time limit concept. So basis all these conditions, a good case to argue, we don't have to reverse the credit. Now moving on to our second case study. ITC on CSR expenditure. Whether I'm eligible to take ITC on the CSR expenditure being incurred by the company. Let me take an example to explain this case study. I am a company. I purchased oxygen concentrator. I donated those oxygen concentrator to various NGOs. So at the time of purchase, I paid GST on the oxygen concentrator. And now I'm donating all those oxygen concentrator on FOC basis at various NGOs as a part of my CSR obligation under Section 135 of the Companies Act. So the issue arises whether I'm eligible to take the credit of this particular ITC which I have paid, or this GST which I have paid on my purchases. Friends, if you see Section 135 of the Companies Act 2013, it specifically requires every company having a specified net worth or turnover of profit to contribute at least 2% of its average net profit towards satisfying its corporate social responsibility. So it is a mandate, it's an obligation under Section 135 of the Companies Act that I have to do such kind of activity. And under this obligation, I did donation of oxygen concentrator. For checking whether ITC is available or not, for examining this issue, we need to see two sections, Section 16 of the GST Act and Section 17. When we talk about Section 16, it is an eligibility section which provides that a taxpayer is eligible to take credit of any goods and services on procurement if it is used in the course of furtherance of business. So the first test which we have to pass is whether this expenditure is in the course of furtherance of business. The second test which we have to pass is whether I'm excluded under Section 17.5 in view of the specific exclusion list which is there in Section 17.5. So let's test the first condition first. CSR is an expenditure which we are incurring as a part of Section 135 of the Companies Act. It is a compulsory expenditure which is incurred by me. If I'm doing my business, then in such a situation, it is required that I comply with all the laws. And one of the laws is Companies Act 2013, which provides me to do such kinds of activities. So if I'm doing such kind of activity as per the law, then this is definitely in the course of furtherance of business, because the term business is very wide. In fact, under excise regime, we had various judgments which specifically said that all such expenditures are nothing but in the course of your business. Sustainability of company depends on CSR, without which the companies cannot smoothly operate for long period, as they are dependent on various stakeholders to conduct business in economically, socially, and environmentally sustainable manner. That is what said by SL Propec, and they said that yes, this is an expenditure in relation to your business. Similarly, even in advanced rolling, Dwarkashi Sugar Industries Limited, they specifically said that all these CSR activities something which is compulsory required under the law, and hence it's a part of your business process, and hence in the course of your business. So the first condition is satisfied. Moving on to the second condition, whether I'm excluded under Section 17.5. What does Section 17.5 says? It says it ITC when goods are written off or disposed of by way of gift. So can I say that when I'm donating oxygen concentrator to NGO, it is in the nature of gift, and hence credit should not be available to me? What is gift? Gift is not defined under the GST law. But when we go to the dictionary meanings and various other prudence, we will come to know that gift is something which is given voluntary and without consideration. So something which is given on your own, voluntary and without any consideration, that is called gift. Friends, there is a difference between something to be given as gift and something which is given as an obligation. What do you mean by an obligation? Obligation means a duty or liability arising in law or from contract. So it is a duty or a liability which arises in law or from a contract. So whatever the mandatory nature of CSR expenditure itself shows, that is nothing but a duty and an obligation which we have to fulfill. So in my view, the donation of oxygen concentrators to NGO is not in the nature of gift, rather it is in the nature of an obligation which I have to fulfill under Section 135 of the Companies Act, and hence I should not be debarred by Section 17(5). Moving on, this Schedule 1, what we even discussed in the first session. Schedule 1 says that if you are disposing any business assets on which you have received or availed ITC, it will be deemed to be a supply. So Schedule 1 entry, there is a deeming entry which says that disposal of business assets on which ITC is availed is a deemed supply. In my view, even Schedule 1 is not attractable because these are not assets. The oxygen concentrator is in the nature of an expenditure which I have incurred and not in the nature of an asset, and hence Schedule 1 will not be triggered. So there is a possible view that credit on such oxygen concentrators will be available to the company, but this view is highly prone to dispute. Department at ground level may not accept this view. Even the GST policy wing is considering to issue a circular to clarify their stand. It may take such time. There is an alternate mechanism for those companies who want to be litigation free and who don't want to take a disputable stand. So what they can do is that, to my mind, it's a good case to argue ITC is available. But if you want to be litigation free, the stand which can be taken is that I can take the ITC of the CSR expenditure of such oxygen concentrator in a particular 3B month, return 3B of a month, and reverse such credit in the same month. So take the credit and reverse the credit in the GST return of the same month. So effectively, your credit ledger will not be hit. What advantage will you give? The advantage which you will get is that you claim the credit, then you reverse the credit. Down the line, if there is any positive circular or if there is a positive judgment, you can reclaim, you can reavail that credit without any time restriction. So that is one of the approach which can be followed by the industry. Moving on to the third case study for the day, payment of consideration within 80 days. And Section 16(2) specifically says that where a recipient fails to pay to the supplier within 180 days of the date of issue of invoice, the amount equal to the ITC shall be added to the output tax liability along with the interest. So take a practical case. I am a purchaser of a capital goods. The amount is huge, say 5 crore rupees. And my payment term is such that I will pay 25% in the first quarter, 25% in second quarter, 25% in third quarter, 25% in fourth quarter. And these are generally the payment terms whenever we talk about purchase of capex, etc. So on the first day, when I received the invoice of the capital goods, when the goods was sent to me, I availed a credit on the basis of those invoice, even though the full payment was not made. After 180 days, am I required to reverse the credit in this example? For this, please read Section 16(2) again. What it says, where a recipient fails to pay to the supplier. So it starts with a clause where the recipient fails to pay to the supplier. What do you mean by fails to pay to the supplier? The word failure means non-fulfillment of an obligation imposed. Failures means not doing something that one is expected to do. In this example, when my initial purchase order or initial contract itself stated that I have to make payment 25% each in every 4 quarters, then how I have failed to make the payment to him? Failure to pay means a Malaysian airline judgment, very important judgment. Failure to pay means non-payment, which means failure to pay when due. When this amount was not due to be paid, how can it be a failure? In my view, since Section 16(2) talks about failure to pay, in such kind of cases, there is no reversal which is warranted. So you have to keep in mind the language which is used in the contract. Please define your payment terms clearly and make sure it is due. The wordings are written properly when and where the payment is due. So a good case to argue wherever you find a litigation notice on such kinds of issues. Moving on to the last case study, and considering the timeline, I will be finishing in another 2-3 minutes. DGGI investigation in real estate projects. So what is happening? Friends, we are aware under Rule 42, we are required to reverse the credit to the extent I am using it for my exempt services or exempted goods. So if I'm a manufacturer of taxable goods as well as exempted goods, I can avail only proportionate credit. What is a mechanism? Full credit in respect of those taxable goods. I can avail full credit in respect of those inputs or capital goods which are used for taxable goods exclusively. No credit on inputs and capital goods or input services which are used exclusively for exempted goods or exempted services, and proportionate credit in respect of common services based on turnover ratio. So this is generally the Rule 42 mechanism. But for real estate, Rule 42, there is a specific mechanism for real estate industry. So let us take an example to understand this. I started a project in GST regime. I am a builder. I am a real estate player. I started a project in 2014. I was supposed to build 500 units. I am selling those units, taking payment from the customer and paying service tax during that period. And after GST, I started paying GST. On 31st March 2019, completion certificate was obtained in respect of those particular project. And then you found that 33% area is unsold. So what you did, you started project in 2014, you started availing all the service tax credit for the construction of those projects, you started availing credit in GST regime, you are also selling after paying service tax or GST, and now on 31st March 2019, completion certificate came, and on that day, 33% area was unsold. So whenever you will sell this area in future, you will not pay GST on that. So whenever you sell this 33% area, you will not pay GST on that. So when I receive an OC, Rule 42 specifically says that for a real estate project, whenever you receive a notice, then whatever credit you have availed in GST regime, that is from 1st July 2017 till date of OC, you have to reverse the entire credit based on the proportion of area unsold. In our example, construction cost was 100 rupees, service tax cost was 10 rupees, ITC, which service tax credit which I have availed in pre-GST was 10 rupees, and ITC credit which I have availed in GST regime is 3 rupees. So when I got the note OC on 31st March, 33% area unsold, ITC which I have to reverse is 33% of rupees 3, that is 1 rupee, no doubt. But the real challenge is, what about the service tax credit? Am I required to reverse this service tax credit of 10 rupees? And in this respect, DGI Lucknow has issued notices to more than 100 builders asking them to reverse the credit. In my view, it is a strong case to argue that no reversal is required. In my view, it is a strong case to argue that no reversal is required. Why? Because under GST, there is a deeming provision of reversal of credit. The way Rule 42 is drafted, it specifically says that whenever you receive an OC, you have to reverse the credit starting from 1st July 2017. There is a deeming provision under Rule 42. But when we talk about service tax regime, there was no such deeming provision. There was no such deeming provision for reversal of credit for a real estate industry. And at the time when I availed the credit during the service tax regime, I never knew whether I will be using it for a sold unit or an unsold unit. When I was getting the building constructed in 2014, 2015, 16, I was availing the credit, and my intention was that I will be selling all those units on which I will be paying GST. My intent was always to sell those units. And later on in 2019, I came to know that 33% area remain unsold. So you cannot go back and demand the credit reversal. At the time of availment of credit, my intention was to sell and pay service tax on the output. There are 3 favorable judgments on this issue which has come for the real estate sector. Alembic Limited, Shreno, Prajapati Developers, and 1 and 2 more judgments have come. So in my view, it's a very, very good case to argue that no reversal is required in respect of receipt of OC in GST regime for a project in respect of those credit which you have availed in GST regime, service tax regime. However, for the credit which you have availed in GST regime, yes, you have to reverse the credit. With this, I end my presentation. Thank you.